these are the patterns that will indicate a change in price direction after the pattern is confirmed. The first chart pattern we'll analyze is the famous head and shoulders pattern. The head and shoulders is a bearish reversal pattern, and it looks like this. Notice that price will be going up, and after the pattern it will go down. There are a few important elements in a head and shoulders pattern. We have the shoulders, which are highlighted by numbers 1 and 5, the head, which is highlighted by number 3, and the neckline, which is highlighted by the line connecting numbers 2 and 4. This chart pattern receives this name because the price action will resemble the shape of head and shoulders, which is something that makes it easier to remember and detect the pattern in real time. The logic behind the pattern is that price action will make a downward turn by failing to produce a higher high in number 5, meaning that price will reach a peak in number 3, and a failed attempt to surpass number 3 in number 5. All of this means that sellers are gaining power as buyers exhaust their energy. The important thing to pay attention when attempting to trade a head and shoulders is the neckline. This is the line that will tell you when price action breaks out of the pattern, therefore confirming it. And it's also the line that will tell you where to enter the market. The ideal way to trade a head and shoulders pattern is by letting price break below the neckline and wait for price to come back and retest this line. Some people attempt to enter a short trade as soon as price breaks down the neckline. But the problem with that is that you might enter in a much less precise point, so you end up taking more risk and a smaller potential return. As I said, the ideal situation is to wait for price to retrace back up to the neckline, and as price reaches the neckline, it's also important to check for signs that price is indeed respecting the neckline as a resistance. For example, if price comes back to the neckline, and as it reaches it, price creates some sort of bearish reversal candlestick pattern, you can think about going short. This is just one example, of course. There are thousands of different things that can happen if price comes back to the neckline to retest it. So in summary, there are mainly two ways of entering a trade using a head and shoulders pattern. You can wait for price to close below the neckline and use that to trigger a trade at market, which is a more dangerous entry, or you can wait for price to close below the neckline and come back to retest it, also observing how price reacts as it reaches the neckline. Beware that it's certainly possible that price closes below the neckline and then starts to rise again, completely disrespecting the neckline. That's why it's important to enter in the most precise place possible, as it will be less risky. Beyond the entry, you also need a logical stop loss placement and a logical target, and those will depend on the type of entry you choose. The logical stop loss order is above the high number 5 because as price breaks down the neckline, high number 5 will become a confirmed supply zone, or a point where sellers confirm their power. If you don't know how supply and demand trading works, check out the Ultimate Beginner's Guide to Supply and Demand Trading in the YouTube card. This is the safest stop loss to use in a head and shoulders. Now you can begin understanding why waiting for price to retrace to the neckline is a better idea. It's because it will diminish the size of your stop. You can also put your stop above high number 3. As your stop loss size increases, your take profit target will have to increase proportionately as well. And the larger your take profit, the lower the chance that it will be hit. The general rule for take profit target is that it needs to be at least 3 times as big as your stop. And that means you need to have the discipline to let price either hit the stop or the target. You cannot close the trade as soon as price goes into profit, as this type of thing will ruin your account in the long term. Some people talk about measuring movements to create targets, but that doesn't make any sense in my view. Another detail about the head and shoulders pattern is that the neckline might not always be horizontal. Sometimes it can be sloped to the upside or sloped to the downside. You have to be careful when that happens because you want to put your stop loss order above highs that confirm the power of sellers, meaning highs that precede lower lows. Next in line we have the reverse